Welcome to Dividend Talk, episode 273. 5 stocks we are buying for Christmas. Hey, if you want to join the conversation also after the show, come join us on Facebook or Discord. There's a whole community of dividend investors there sharing ideas, helping each other out and keeping each other motivated. And you will find the links in the description below. Let's get started, guys.
Well, we'll get a move on. You might hear my voice is struggling a little bit, so I might struggle to finish out this whole show. So I'll do my best with this. But what is going on in the world this week?
Well, before we go there, let's discuss a little bit also for our listeners what we will actually do in the show. So first of all, we will talk about the news of the week. We have to talk about Netflix acquisition a little bit, because that's a quite interesting one. Also about the Magnum Ice Cream Company, it's also in the news. We have quite some dividend announcements, one of Morningstar's and one of the salty snack makers that Ian Lopuk really likes. So Ian, if you're listening, that one is hike the dividend, so stay tuned. And then we really talk about five dividend growth stocks. I would say there are like 2 European, 3 American, so a little bit of a mix. Companies, most of them we don't always address here, or not often here. And we have quite some listeners' questions again. For instance, what to do when it comes to retiring on the current dividend portfolio. How will we deal with a certain market drop for 40% if we would start today? Those are our thoughts on the data center boom or owning LVMH through CDI. So quite a nice show again. I'm really looking forward to it.
Yeah, sounds like it's going to be a lot of fun. So let's start with Netflix to acquire Warner Brothers. And look, we know this company famously through AT&T, where they owned Warner Brothers. We used to criticize that. They sold the company, but also cut their dividend at
the same time. Yeah, that's what they did at the time. It was quite nasty. I remember that they said and we will pay a competitive dividend. Well, we know what competitive dividend means nowadays, because every time a company says it, the dividend is likely to be cut in the next 12 months. So that's very interesting. Now, what caught my attention is more like, look, this Stinky, right? The CEO, he is one of the worst CEOs of our time. Yeah, compared to Larry Culp, who did a Houdini act on General Electric, or Satya Nadella. Yeah, but that's in the tech space. But let's keep it a little bit to the non-IT. Although you could argue Netflix is, of course, very much a tech company. So I guess the only good thing he has done is to spin off Warner Bros. Because he spun off Warner Bros. For around 43 billion. Yeah, and that was like debt and equity. Now, Netflix is acquiring Warner Bros. For an enterprise value of almost 83 billion, yeah, or 72 billion in equity value. So that's nearly double, or you could say that's double, yeah, of that. So if you held on your Warner Bros. Shares that you got spun off by AT&T, then I assume people are now having doubled their money in 3 years.
Yeah.
So that's probably the only good thing John Stinky ever has done, giving it to someone else, knowing that he's too incompetent to manage it himself. It's a quality, right, to know your incompetence.
Yeah, yes. I mean,
so finally, all those millions that he's harvesting in from the company salary is now finally having some reward there. Yeah, it's an interesting one, right? Because first of all, Discovery will be spun off from Warner Bros. So they take the Warner Bros. Assets. So what are we talking here about? HBO Max. So the streaming service plus the content, yeah, HBO. So these are things like Game of Thrones, yeah, very popular. So I wonder if these will now be always available on Netflix, because what Netflix started to do at a certain moment, they pull back series again, right? And then only offer it sometimes because it's cheaper for them. So I hope they don't do this, because what is also very interesting at the moment in time, if you look at streaming, I don't know for you, for me, it became very expensive, everything. So I started canceling a lot there, and I focused mostly on the ability to watch Premier League. Yeah, so that's what's been happening. So many people went again to pirate sites, yeah, to download movies and series, because it just became too expensive. And what those providers are also doing is they're not offering all their content continuously. So they offer it for a few months and pull it off again with many of those things. So it's really not customer centric anymore. So I wonder really how much they are going to earn from this. It's a lot of money, and AT&T wasn't even able to get proper money out of it. But hey, they're expecting 2 to 3 billion of cost savings per year by the third year, and they expect that the earnings start to add to the EPS after 2 years. So it's clearly a mid to long-term investment. I guess they can slash a lot there because it sounds a little bit like HBO is managed more classically and Netflix more modern and more lean. So some duplicate management, duplicate assets there. So I think they will be able to quickly figure it out. Here. That's a lot of money. That's a lot of money.
It is a lot of money. But look, if you think of a company that could extract value out of Warner Brothers, Netflix would be top of my list. I have to say, you mentioned about streaming. We use Netflix quite a bit in this family. So yeah, I'm looking forward to have access to some of the HBO shows.
Well, they're just taking also a competitor out of business. Yeah. So I don't think it's necessarily just the content. It's also like, again, one competitor less.
Yeah. But if you're a person that was streaming from both places, you might be able to consolidate your costs into one company now and have access to the same content, which is nice for the consumer.
Exactly. So, hey, let's see how that goes. But I think if you held on to these shares after the AT&T spin-off just by procrastination, you may actually have done well.
Yeah. You would have recovered that money you lost in the dividend, put it that way.
Yes, exactly.
Anyway, the Magnum Ice Cream Company, so they are demerging from Unilever. And I suppose this is not really a surprise. It's been talked about for maybe 2 years at this stage. But what are your thoughts on this? You're going to get some shares.
Yeah. So I listed it because tomorrow the demerger is happening, actually this weekend. So tomorrow it starts trading on the Amsterdam Stock Exchange, the London Stock Exchange, and the New York Stock Exchange. So what you need to know is we will receive 1 share of the Magnum Ice Cream Company for every 5 shares that we have. So I'm checking. That would mean for me, I own more than 200 shares. So I will probably get 40, 50 shares of the Magnum Ice Cream Company. I will not sell them directly. I will first study them a little bit, wait a quarter before I do something with it. I also like to understand their dividend policy potentially here. So I'm not going to get rid of it directly. What I've noticed over the years is that many of the stocks that have been spun off, they do 1 to 2 years poorly. Think about Siemens Energy or some others. And then suddenly management really, starts to build a company, deleveraging, and starts to do better. So I want to study that a little bit more based on that learning before I just throw it away and invest it elsewhere. Yeah, so that's my plan here, I think.
Is that influenced by Warner Brothers by any chance?
No. But actually, now that you say it, you could draw that parallel there as well, right? Yeah.
Cool. Okay, so we move on to your favorite section of the week. I think you always get excited with this one, with the recent dividend announcements. I usually rattle them off, but I might give you the honor just to save my voice a little bit here.
Yeah, first of all, this company we use sometimes, right? And it is also a nice integration with Interactive Brokers, because I think we're often interested in what Morningstar analysts have to say, how they look at the company, and then the famous 5-star rating and such, right? And what their moat is. So they are hiking the dividend to 50 cents quarterly per share, which is an increase of, again, 10%, actually a little bit more than 10%. So a really nice one. And I need to look into Morningstar again, because there's something with this company that always attracts me a little bit. I looked into it from time to time. I guess the dividend was not strong enough, high enough at that time. So I'll have another look at it. Owens Corning hiked the dividend by 15%, another double-digit hike. And then UTZ Brands, and this is the one that I referred to Ian Lophook here because he made quite some videos about. It's a salty snack maker, and it's so nice when you see Ian always just opening a bag of chips or something like that and eating, and then on Instagram sharing, what he thinks of a stock. It really brings it home, right? But they did a dividend increase of 3.3%. Not a lot. I looked into the company when I was studying generally the consumer staples sector, and I saw that they were struggling a little bit at this moment in time. So I think shareholders will still appreciate this. Enbridge with a 3% dividend increase. Bank of Montreal a 2.5% dividend increase. National Bank of Canada 5.1. dividend increase, but then I guess the greatest of all time of the Canadian banks, Royal Bank of Canada, with a 6.5% dividend increase. So all the dividend stocks of the Canadian banks decided to hike the dividend this week.
Yeah. I mean, we've had a number of guests on the show from Canada, and they've always said Canadian banks are different. And to be honest, we haven't had any reason to doubt that since the 5 years we've been doing the show.
Give it another 5 years and we'll come back to this. In the end, these are banks.
It's hard to convince you. Yeah, so look, some nice dividend hikes there. Morningstar is obviously the most interesting with a 10% hike. So quite an interesting one, and one that people might be looking to add to a dividend portfolio, considering we've used their research quite a bit. So this week we're talking about our Christmas wish list. And to give a flavour, there's 20 companies on my watch list at the moment, and it's easy as a dividend growth investor to get pigeonholed into a certain word, because you look at the same companies over and over. Like, we don't need to be that exciting. I don't need to know or own 200 companies.
No, dividend investing is supposed to be boring.
It's supposed to be boring. So as a consequence of that, on this show, we do probably talk about the same couple of companies all the time. So we took that on board for this one. But just to give you a little bit of flavour what's on my watch list, I have companies like Schneider Electric, I have Spirax, I have MSCI, I have Glanbia, Target, and EOG Resources. So with the exception of Spirax, I think I probably speak about the others quite a bit on the show. So I deliberately did not pick 3 companies from my list. So I looked outside of my list and go, okay, what ones would interest me now based on some screeners I ran, and we went from there. I actually used Morningstar to come up with some of these as well as our database. But when I was looking at, say, when you want to look quickly at what's the bear case and the bull case, they have this nice little piece at the end of Morningstar. So I do like that when I'm quickly looking at companies. And the first company I came across, I don't know if you ever heard of them. They have 25 years of increase in dividends. So technically an aristocrat, but they don't fall into the official aristocrat list. And it's Eversource Energy, ticker symbol ES. We spoke, well, I think we did speak a couple of weeks ago about the boom, or maybe we wrote about this electricity boom that's going to happen in the United States based on data centers, AI, increased energy. And myself and Jeremy had a conversation about this type of topic as well. So I think there's huge upside potential for these types of companies, utilities in the United States, if this target is going to be reached. And I can't remember off the top of my head, it was something like 120 gigawatts of like peak power added in the next 5 or 6 years, which is a lot of power. So looking in utility space, I know they come with their risks. They have high capex spending, but they are regulated, they are consistent, they normally pay high dividend yields, and this one has got a really strong track record of over 25 years, which gives you a bit of confidence in the company. They do serve about 4 million electric and gas and water customers in the US Northeast, so it covers the kind of trifecta of utilities that everybody needs. Everybody needs heating, everybody needs water, and everybody needs electricity.
So when you say Northeast, this is the Boston area?
Northeast is kind of, yeah, up around Boston.
So above New York. Okay.
Yeah. So yeah, looks after all 3 of those, which I quite like. Sometimes you get one with just electricity, gas and water, but when you have all 3 together, I think there's no shortage of customers with that. So they are kind of like, they did have one blot on their kind of balance sheet recently, so there was huge divestment. I think they took over some Aquarian water company, which they've had to write off. It didn't work out for them. And what they were trying to do, they were trying to pivot a little bit into, say, renewables and offshore renewables, but the margins weren't high enough. It wasn't returning enough for them. So to be fair to them, they've just kind of cut that. They're getting rid of about 2 gigawatts of offshore wind projects, and they're just refocusing on what they're good at, and that's land-based electric, water and gas, which I quite like. Management's guidance sits at around, EPS sits at around 472 to 480, which is kind of flattish from last year, but they are projecting some growth from next year. I think the divestment from this year is really hurting the bottom line, obviously, but they are projecting over the next 5 years between 5 and 6% earnings per share growth, which should translate then into the dividend growing at around 3 to 4%.
That's a lot for a utility company, to be fair.
It is a lot, I have to say. It's quite a bit, but it's a big region. And again, it's all based around these projections that this AI boom is going to bring increased demand. And look, we spoke about this, whether it will happen or not. We're kind of on the fence about, but I do definitely think demand will increase naturally over time anyway. 5 or 6% might be aggressive. I would be happy maybe with 3% from a company like this. So if they're overestimating and it falls somewhere close, I would be happy enough with that. But look, again, the one thing that attracted me to the company was its dividend history, 25 years. The payout ratio is a little bit on the high side. Again, the divestment is probably skewing that this year, but historically they're quite well managed. So yeah, look, typical utility probably has a high level of debt. Their interest coverage around 2x, but that's not untypical for what you get with utility. And yeah, an interesting one, especially if you believe in this electricity AI boom that's going to happen in the United States. So.
And it's interesting what you say, right? Because often people get scared from the debt to equity ratios. But what is good to know is what you see often with very, very stable cash flowing companies, whether it's utilities, because quite predictable, or the likes of Ahold Delhaize the same. They have high debt because they can afford it because of the predictability. Yeah. So what is more important there is the interest coverage ratio in those moments, and understanding at what the interest is going to do in the near to midterm, to see if it's going to hurt them or not. It's the same a little bit with real estate investment trusts, So you don't want fluctuating cash flow companies to have those like kind of debt levels. You really want it below 60% for a margin of safety. But I think these kinds of companies can deal with it better. Of course, sometimes it blows up in their face, if they overreach. But I just want to say to in people that are listening that it's always important to understand the context a little bit of why there is debt on the balance sheet and how that looks like.
Yeah, I think so. Look, I didn't even mention that their starting yield is around 5% as well. And I anticipate further growth over the next 5 or 6 years at least. So with a 25-year history, you'd be quite comfortable that management know how to manage a balance sheet enough.
And the Chowder rule, I think, for utilities was always 8%, right?
8%, yeah. And if I look
at the 12 for the others,
If I look at their 5-year growth rate, it's 5.8%. So you're getting about 11% year over year. So
interesting. So we know you like the energy stocks, utilities for the AI boom. I think we have also a question later for it. A company that I would like to talk about, and it's a company that I just initiated a position in. So some premium subscribers are already aware of this because I typically put my transactions on Discord in the premium section. And it's automatic data processing. Ta-da! Because if we talk about the definition of quality, this is what comes to mind for me. They effectively, in my opinion, have a very strong moat. Are one of the only companies in this space as such, which is a very interesting space for me. So what do they do? First of all, if you say it officially, it's a provider of human resource management software and services, but it's specifically known for the payrolling. So many companies do their payrolling via the ADP solutions. What's the British company that does something similar? Sage, SAGE.
Sage.
I have also Paychecks. I also own Paychecks. Paychecks is, let's say, more focused on small and medium enterprises, and ADP is focused on large enterprises. So I'm going to cover now America, all companies in America with those two holdings. And who knows, maybe I will do Sage one time and also start entering Europe with this. But I really like this kind of business because this is like SAP. Once you're in, you're locked in. It's really hard to move away from this, to change your HR systems, because you have very much of an impact on the salaries you have to pay also to your employees. So it does more talent management, workforce management, and other functions, but their core, I would say, is really around payrolling. And it was a pioneer in this, right, when the computers came up. So for me, a very interesting company with a very strong dividend growth track record. The 5-year dividend CAGR is around 13%, 50 years of dividend growth. And they literally say that their dividend is the cornerstone of their long-standing commitment to the shareholders. here. So very, very interesting. Currently, it yields 2.62%. So I bought it at $250. Not too long ago, it is now trading at $260 again. So the yield was around 2.75%, my minimum yield for such a company. But I bought it because for me, it is such a company that screams quality. Yeah. So for me, it is the definition of quality when you think about it. So the company has been growing. 5-year revenue CAGR has been 7%. 5-year EPS CAGR has been 11%. A debt of equity of 0.6 and a credit rating of AA3 also shows that there's a really good balance sheet. Payout ratio is around 60%. And yeah, it just continues to grow over the years. And of course, there is some sensitivity here towards the economic conditions. So I'm actually hoping for that, because if that would have an impact on the share price, I can get a better deal for these shares. And this is initiating position. But that's why I also thought about it for Christmas, because, with Christmas, there also needs to be a bit of fantasy and magic. Yeah. So how cool would it be if it starts crashing now, like literally crashing over the next 2-3 weeks? Because I don't know, fund managers, they just so want to get it out of their portfolio for their end of year statistics to look nice. Imagine it would go to 220 or something like that. How cool would that be? So this is what I really hope from Santa Claus. So if he's listening, please get it to me there. It would make me very, very much appreciating this. I mean, if you think about it, right, how I look at this, there's still so much, how is it, growth going in the world, in the world, also in America, in terms of employment, the AI boom. So I think just generally it is doing well, and it will continue to do well. There is a bit of cyclicality in it, but and that's what I think you really need to look for, because when businesses reduce their workforce, it could lead also into a decreased demand for their payroll services. Another risk that you always need to watch out for, and we had this with this other company from New York, I forgot the name, but you don't want employee data on the street. Yeah, so if here will be a security breach or something like that, that will be very much potentially negatively impacting this company. I've always wondered, by the way, why ADP didn't acquire Paychecks yet, because I think it would be very good complementary to their portfolio. But so far they haven't done yet. But I can, this is interesting, right? This is an industry where people will always be innovating with new kind of software. I can imagine that there are now a lot of AI agents being produced for HR and payrolling. Yeah, ADP just needs to scan the network, take the first ones that are a bit successful, buy them, scale it globally by integrating it into their software. And this is how ADP can stay on top of all of this. Yeah, that's the nice thing. If you have such economy of scale, such a client base, you can even afford to overpay for those small companies, because you can scale it across your whole portfolio potentially. And that's where really it's a benefit, I think, for large companies, that for which it is therefore also really hard for those small companies to exist still after being successful. They just get gobbled up quite quickly.
Exactly. But if your aim as a small company is to sell out eventually, then it's not bad.
So I think, listen up, the company is not cheap. Yeah, it still has a price to earnings of 25, price to free cash flow of 23. It is a little bit above what I usually want to do. I usually don't want to go above 20, but that's why I have the other one with the 2.75%. That is kind of allows me to buy quality, probably because still the dividend compensates enough. And if it continues to grow the dividend with a compound annual growth rate of 10% over the next 5 years, then I will have a nice yield in hindsight. So that's how I look at ADP. Very happy. I think if it ever were to crash, it could grow really to a large position in my portfolio.
Yeah, very nice. It's a very nice company. It's one that I owned way back. I've told you some of my lessons learned. I bought them at $107, $108 and sold them at $140, thinking they were over.
And I'm happy buying it at $250.
Yeah,
but it tells you what price anchoring does. Because if you would have bought at 110, you would probably think, "Oof, 250, it's a bit expensive. I bought at 110. Yeah. And I'm here a happy owner at 250. Yeah, that is a good lesson, right? When people think about price anchoring, it's really, I had to learn to fight that over time and try to erase it from my mind, the price that I bought at, and only think purely at, would I buy it today?
Yeah.
Would I initiate a position today? Would I want to increase it today?
It's not easy, but automatic drip helps with that as well, because it takes that out of your mind.
Yeah.
Nice choice. So the second company, I went back to Europe this time, and you're a fan of Euronext and I am a fan of London Stock Exchange.
Yeah.
So they are the two largest, I would say, brokers in Europe around that. So in number 3 on that list is Deutsche Börse Group. Now, forgive my pronunciation, but they are quite a large Frankfurt-based market infrastructure provider. And I actually would have thought, before we did the deep dive analysis on both London Stock Exchange and Euronext, I would have thought that one of those two would have gobbled this company up by now. But actually, they're too big for European regulators to allow that to happen. And this London Stock Exchange tried to do that a number of years ago. And you know the way Europe goes, they're like, nope, not happening. You get too big, there'll be no competition. So I don't think that's going to happen from either case. But basically what you're getting here is a traditional broker. They're in like trading venues, cash equities, derivatives, clearing, settlement. They're in index and analysis. So I'd say more similar to Euronext than London Stock Exchange. Yeah, quite of a similar vein. Obviously, the Frankfurt Stock Exchange is quite big, and I think if you want to own all of Europe's stock exchanges, having them and Euronext together is probably a good little mix to have. So yeah, look, it's quite a nice company. It has this Horizon 2026 strategy, which was quite interesting to me. They use a lot of big words, so they are targeting sustainable secular growth driven by product innovation and new client acquisition and all this. But basically what they're trying to do is just buy all the little guys, like you were saying, try and steady, because like clearinghouse and stuff, they go through peaks and troughs, and they're just trying to steady that a little bit. So they have like this aggressive acquisition cycle coming up, which may impact some of their capex stuff as well. But at the moment, they're trading at a dividend yield of around 1.8%. The dividend growth is 7.7 over the last 3 years. So the yield is a little bit on the low side for what I typically like, but you do get decent growth with that. Doesn't hit the Chowder rule of 12 if that's what you're after, but I think it's just a nice company to have to complement Euronext if you're looking to have all over Europe coverage. Obviously, the thing with brokers is you have regulations, so huge regulation can impact these, and specifically in Europe, regulation can be quite strict and tough, which we know particularly in the finance sector. So that's obviously one thing to look at, but they're growing quite heavily over the last couple of years. They target around the 40% of net profits to shareholders for dividends, which I always find important. So once their net profits are growing over time, their dividend will grow. But yeah, purely on the basis, I still think I prefer London Stock Exchange-ish, but I think on the basis of diversification within Europe, I think this is a good alternative.
Boy, Derek, if people would see you, you're so struggling with your voice.
I know. I have a lot more wrote down, but I can't.
Yeah, respect, Derek. I'll try to help you out to talk a little bit more, but you still need to do one stock soon. Yeah. But yeah, I think we're both quite fan of this whole industry, right? These are these platform providers. For me, the biggest bull case at this moment in Europe is that the European pension system is cracking, and more individualization is coming up with pension investing. Yeah, the Swedish model is very much being praised. The European Union wants us to invest more as well to be competitive at the world scale, because Europe is losing track from America and such, right? So I think there's so much long-term opportunity here. I believe it was in the Netherlands where there's 500 billion euro on the savings accounts of people. Imagine that 100 billion of that will flow to, because of favorable policies, to invest yourself to the stock market. All of this, I think there's such a long runway here for these kinds of companies that it's very interesting to look back at that in 10 years from now, how that played out.
Yeah. And I feel like there's a bit of trust coming back into this, like investing yourself. Like after that great financial crash, a lot of people lost trust. I mean, that generation now is almost nearly over that, and you have a new generation coming through that don't have that pain. We did have COVID a little bit. COVID was different in terms of it affected everything and everywhere. So I don't know if people even associate a market crash with COVID.
But the finance industry.
And we recovered so fast after that, it's probably just a blip on the radar. So I think there's a lot of confidence coming back in people investing. I see this, a lot more individuals are coming to me that's in my peer group, say, asking, curious, wanting to start investing, and around that, like wanting to take control of the future with the pension, because over in Ireland, you have to be 67 now, I think, before you can retire, and that age just keeps going up and up. So I think people are starting to take control of that. In Europe, to be fair, are trying to help, and through regulation, I would say, but they are trying to help people get involved. So it's win-win for me.
And so this one you want under the Christmas tree, if you could have a wish.
Yes, I would put that next to my London Stock Exchange.
Awesome.
Quite nicely.
So then I will talk about a company that we have spoken before about, and we often do it in the earnings updates, but I don't think we speak often deep about it. And that's Wolters Kluwer. And why Wolters Kluwer? I think it's for the first time in reasonable range. The share price crashed almost 50% this year, Eric. So there is one thing that if you are, let's say, an investor that is more interested in the price and the valuation, many companies that are trading lower than at the start of the year are often being also sold in December, right? I referred already to that a little bit, for tax harvesting, for the fund managers to look better by not having them in the portfolio in the end of the year. Oftentimes, and I don't know if there's any research done to this, but I've seen it in my portfolio that those stocks start to do better the next year after. Yeah, and then I always say, like, when I do tax harvesting, after that, the stocks go really up. Yeah, think about Bayer, General Electric. Of course, those were broken companies, but still. So I'm wondering if Wolters Kluwer is this rare opportunity still for the upcoming weeks, and after that, next year, we'll see it fly away again, or whether it's here to stay. I can't tell you, but we'll touch a little bit on one of the big threats soon here. So Wolters Kluwer, if you don't know it, imagine yourself being a lawyer, and you need to prepare for a case. You will not have all the information available about the law. Yeah, you can take some books, but the law evolves as well. Wolters Kluwer gives you all the up-to-date information around those particular laws, but also about former court cases, precedents that have happened. Yeah, so there's a lot of information as a lawyer that you can get out of the Wolters Kluwer databases to prepare yourself. The same if you're working in healthcare and you're doing research, or when you're an accountant, tax and accounting advisor, risk and compliance. So there's a lot here, and they have these databases and effectively a lock-in for many of those companies. Those are high cost databases, but without it, I would say most people could not do their work properly as a professional knowledge worker. So that's what they offer. The current dividend yield is 2.7% for Wolters Kluwer. A 5-year CAGR of around 13%, 37 years of dividend growth. The dividend wasn't really growing between, let's say, 2007 and 2015, but after that, it really quickly picked up and I think almost tripled. The payout ratio is around 40% from cash flow, 58% from the EPS. Their EPS has been growing about 11% compounded over the last 5 years. Credit rating A3. The growth is slowing down a little bit. Still a return on capital employed of 22%, which is for me, again, a sign, an indicator of quality. Yeah, and anything above 20%, I always treat as quality. So if you think about the investment case, it's for me really simple. It's just a simple, boring company with a strong lock-in, a wide moat. Offers also cloud-based solutions, so it's also able to leverage modern technology. It's maybe not the early adopter compared to maybe some other industries, but they're on it. Yeah, here. They're already applying Gen AI and such in support. I think this is probably more in terms of chatbots. I would need to look a little bit deeper into the exact AI. But this is also where there is a risk, because there's, for instance, a company called Harvey in New York. And what's interesting, I follow some real estate investment trust, and SL Green, I think, just rented out space to them in Manhattan quite a lot. So I have a feeling they are overspending, Harvey, but a lot of money is invested in that and effectively trying to eat market share and take market share from Wolters. So their moat is being tested now. Yeah. And what I always say, like, you can have a wide moat until a new technology comes. And for instance, a plane has been invented, and your castle moat doesn't make any sense anymore because you can easily drop a bomb as a plane. Yeah, so that's how I look at moat. I think every moat can be disrupted overnight by technology, but I think it will take a while. But I also think a lot of this sentiment has been put into the share price of Wolters Kluwer. First of all, I thought it was overvalued for a very long time. I've been following this company for 5 years, and now it's trading at a 5-6 year low here. And I also initiated a little position into this last week at 89.70 €, and I really hope to get some more of this under the Christmas tree. I'm a long-time fan of Wolters Kluwer. Yeah, is the company cheap? Definitely not. I would still say it is. Yeah, it's just like I guess a fair price, as how I call it. But of course, it's just an opinion. People should really do their own due diligence if they're interested in such a company as well. Yeah. What do you think about it, Wolters?
Yeah, well, to be fair to you, your patience is starting to pay off with them. We've been speaking about them since 2020. There's always this fear with them about AI, similar to Accenture. Will AI impact them? But yeah, look, I think it's a quality company. I think they'll use AI rather than AI overtake what they do. So yeah, I think they're a nice company. The dividend yield was always quite low, so at 2.7, it looks a little bit more interesting.
And they do every year, I think, $1 billion share buyback or something like that, or 500 million. So that's what I just don't like. They always had the buyback machine on. I feel that it wasn't needed. Yeah. So
yeah, but now that they're a little bit cheaper, it might be worth a while. But you can't argue with 1 million or 1 billion in buybacks every year and a 13.10 5-year dividend CAGR. So,
and I must say they have been still doing this mostly out of the free cash flow. So
yeah.
It's not too bad after all, but yeah,
nice.
Yeah. Now they have an opportunity to buy back more than they ever did.
Yeah. Okay, so I'll go to the last company, which is CH Robinson Worldwide, ticker symbol CHRW. So the shipping industry is always quite interesting, and I think you'll remember Zim International. Remember they had these huge dividend yields.
Yes,
that's typically what you can see in that industry. Maybe not to that extent where they were paying 30 or 40%, but you can see huge dividend yields come and go because it's quite a cyclical industry. So one thing I liked about CHRW is it's in that industry. It does trade at a little bit of premium. I'll say that off the bat, but it does also have a 27-year history of increasing dividends.
Nice.
So it does give you access to the shipping industry, but they don't own any ships or planes or anything like that. So it's kind of like a non-asset-based freight broker, is if I was to put it in an English way. So what they do is they take companies and they match them with how they're going to ship worldwide, whether it's freight, whether it's plane, and that's what they look at. So they operate through two main segments: North American surface transportation, and they have this global forwarding transportation, and that's where the air and ocean and all that kind of comes into. So it's like, I would say, like Match.com dating for shippers, I would say. And they connect about 80,000 shippers worldwide and have around 450 contracts, which equates to around 37 million shipments per year, which is quite mind-blowing. Like, they're one of the biggest in the world, so there's a lot of products that we would rely on that these guys would handle, or at least help people get them to the right place. But it is look, it is quite a cyclical business. It is quite soft at the moment in terms of these tariffs haven't helped. We know this, and they're expecting that to be soft through much of next year as well. But the one thing that these guys have done really well is managed their balance sheet, managed to kind of flatten out these peaks and troughs, and they do that quite well. As I said, a 27-year history of paying dividends really got my attention on this type of company. I am interested in this sector in general. It's just it's too volatile as a dividend growth investor to be in there. So it might be a good alternative.
But would you mind having a little bit in your portfolio just for yield chasing or whatever, like 5-10% of your portfolio? Are you thinking like that, like what I have with growth?
No, so sometimes what I try and do is sometimes I dip in and out. So I have had some companies like Star or Eagle and Zim even, and you get the huge dividends, and then you know they're going to go through a cycle maybe a year later. So I just sell them. But that skews my dividend charts when I'm looking at them as well. So I've earned this much, but it's really kind of dividend capture strategy. So I don't know if I'd like to hold them long term because they're just so unpredictable. You could go from maybe 15% yield to it being cut for 2 or 3 years, and then, do you know what I mean? So it's just too unpredictable a sector for me. But if you can buy it at the bottom and ride the wave high, I mean, you can make a lot of money.
If I could buy everything at the bottom, I would be retired by now.
Yeah, but it seems like this cycles every 6 months nearly from what I'm looking at. So you just got to pay more attention to it. But yeah, look, I think it's quite an interesting company in that space. For me, the dividend yield is quite low. It's 1.6% at the moment. They're trading at a premium. That might go up. As I said, it's expecting to continue to be soft next year with tariffs still ongoing. So yeah, quite an interesting one. I'm not quite sure what you feel about cyclical companies like this. And we have a question later.
And maybe we can address the question straight away then here, because let me quickly check it. It was a question from, was it, let me see. From Hunter. Even with irregular fluctuating dividends, if the bigger mining companies, would you say having some commodity exposure is a good way to ride the highs and such of this, or do you expect a little bit more dividend growth friendly dividend policy? So I have, for instance, BHP and I have Rio Tinto. So I classify them more like a little bit like income factory stocks, because through the cycle, they are able to grow their dividend and have been giving me a lot of dividends. But I'm just also because I wanted a bit of exposure to mining, but I really try to keep that small in my portfolio, so to say.
I think with those types of companies, I would focus more on trying to time in the market, which is something I don't want to do, which is why I try and avoid them. And I've just spoke about sometimes I try and dip in and out of these type of companies, and I try and do that less and less because it's hard to. It's a nightmare for reporting, but again, like I prefer steady, long term, just steady. You know, it just makes it a lot easier for me, and that's why C.H. Robinson kind of stood out for me. I mean, their returns on capital is, what was it, over 20% over the last 5 years. That is way above what you get from most of like the shipping companies that have huge assets, like they're capital intensive.
So you say that, right? But let me give you an example. I bought BHP. It must have been 7-8 years ago at a cost basis of €2,700. Until now, how many dividends do you think I received? €2,300.
Wow.
Yeah. At the same time, it's now worth €3,900 translated to euros. So €3,900 plus €2,300 invested in other stocks. By buying BHP when it was under stress, knowing that the dividends don't grow. And that's one of the reasons why I am keeping it small in my portfolio. Here, but like to your point, only when I know we're in a crash of a cycle. But this is crazy, right? I almost earned everything back in dividends already over that time. Plus, the price still went up. So that has been really compounding for me. And I know kind of where the bottom of the dividend typically is, and that was giving me enough yields.
I mean, it can be quite a good strategy to do something like that. And you can see you're nearly at a tipping point a crossover point where anything you get will be pure profit in terms of completely covered the cost of buying those shares. I just think from a psychological standpoint, buying them low and watching them go high is great, but then watching them go really low is quite difficult. So that's where I struggle. It's not the maths. I think the maths would check out. It's more the psychology of it.
Yeah, I will generally say, like, watch out with this stuff. To your point, I have a feeling that I have quite a mature portfolio, so I can handle that and deal with that. Otherwise, I would definitely stay away for now.
Nice. Okay. So look, we tried to give you a different flavor on the show. As I said, if I was to pick my real Christmas wish list, it would be MSCI instead of Deutsche Börse. It would be Schneider Electric instead of the utility. And then I'm probably leaning towards someone like EOG Resources.
But I have a question for you. You
Go
need to
for it.
pick one of these 5 stocks and gift it to your kids. Which one would it be?
The one of our 5 that we just picked, I would pick ADP.
Yeah, me too. I would also pick ADP. They will have no clue what it is, but
and they'd be better for it.
Exactly.
Nice. Okay, let's move on then to some listeners' questions. And the first one here, there's a Dutch podcast. You might do the naming.
Yeah, if I ever listen to Voorkennis from Beleggersbelangen, actually probably yes. And he's referring to Menno, who has a focus on dividend growth. I follow him on Twitter. He has a really nice section, I think, about, I don't know when, but at some point in time in the past, he invested 100,000 euros, and that portfolio has been on fire with dividend growth companies, high quality dividend growth companies. So I know Beleggersbelangen as well. When I was living in the Netherlands more than a decade ago, I bought it from time to time. I remember, or I may have had a subscription even on it for a year. It's always good quality, but I typically don't listen to that podcast, but I'm surely I've listened once or twice to it. I'm more of a fan of Börse Talk. I always have to say we were earlier with our name, just in case people wonder. I've been always listening to that since it was on BNR. I liked it a little bit more back then than now, but still, it's always good to hear because there are a few analysts on there, one of those female ones that I really like listening to.
Yes. Daz Mikey has asked us about our current dividend portfolio. So how well would you market a 40% market drop in a 6-year, say, bear market? Would you order your portfolio better to survive such a storm?
Well, no is my answer, because I do the spring cleaning every year, and also around this time I look at tax harvesting, where I try to throw out the bad actors. So I've got a lot of confidence generally in my portfolio. Even if there are 2 or 3 bad players in there, it's designed to be able to weather that storm, in terms of dividend safety. So I keep track on the dividend safety of all my holdings, and I feel quite comfortable about that. Also, if I'm aiming to retire with a margin of safety on my dividend income, not even so much from, let's say, a crisis point of view, but I experienced 3 years ago or something like that, an 18% inflation in Poland. And I had to adjust even my dividend retirement forecast, and therefore work a year longer or 1.5 year longer. So I'm more looking at a margin of safety to protect myself in case of very high inflation, because I don't own Polish companies really internationally, and they have lower inflation, so I need to make up for that.
Yeah. I mean, generally, if you're to ask me the question, I would say, no, not really. I'm quite comfortable with my portfolio. But if I was to know that there was a 6-year bear market coming on and that, I would probably try and even out my exposure. I've high exposure in financials, probably skewed to insurance at the moment. Basically, I'm still in the accumulation phase, and that will all out all the time. So if I know that I was going to retire and there was a 6-year bear market coming up, I would probably just try and even that out in some way, shape or form. But generally, I would say no. Steve C. has asked us, do you like to purchase a stock before or after the earnings call? And if so, is your decision influenced in any way by analyst predictions ahead of the announcement?
I like to buy after. So for instance, I always wait. If I'm about to buy a stock and I see that the earnings will be in 2 weeks, I will wait 2 weeks. But only, I need to say differently, only when I have some doubts. Because sometimes what you see is that when, or maybe half of the times at least, when stocks come on my radar, there's typically something under stress going on, specifically in this market that we operate. So then you just want to wait for the earnings call to see whether your thesis is confirmed, if there's any red flag. I rather buy then a little bit more, let's say at a higher price than if there's the stress and uncertainty around the stock, and buy 3 days before the earnings, because will be for me gambling. I will rather wait for this information 3 days later than, and if it runs away from me, so be it.
Yeah. But there is certain companies that follow it, probably a pattern. You look at Intel, wait till afterwards, they're going to drop 10%. That was religious at one point. But then someone like Microsoft usually does really well and they'll go up. So to your point, it probably depends on how under stress they are and how much you're watching.
Yeah, exactly.
Orion has asked us about the small part of your portfolio which is aimed for growth. Do you prefer dividend-paying stocks with low yields but high growth? So say someone like Visa, MasterCard as an example, or is it the classic non-dividend growth stocks, etc.?
So yeah, what is classic, right? So it's not the stocks of Peloton and these kinds of things, or Palantir, or these. No, well, actually, Palantir I could have done, and I was about to pull the trigger at the time at $8, but I think I bought some Google back then. So of course, Palantir would have done better. But it's still what it needs to be. It needs to be a fast-growing company with real cash flow behind it, so not early stage loss making, and it needs to have a long runway, and it needs to still give an attractive value. So I was buying Meta at the time for under $70 or something like that. I sold it at 500. Google, I have some Google there. Interestingly, many of them, they become dividend payers at some point in time. That's what I'm noticing. So now, for instance, I have a little bit of PayPal as an example. Yeah, so I see the company growing. I see that there is a lot of narrative about it that's very bearish, but I don't see it in the fundamentals. I see a new CEO coming in that seems to be really bringing some of the fight back in the company. So those are the type of companies I would say.
Yeah, from the outside looking in, it sounds like they're companies that are maturing.
They are maturing. They're at the brink of maturing, but still having a lot of growth.
Yeah. Palantir was always an interesting one for me, but I never bought them because I could not tell you what they do.
Yeah,
So
I've been watching videos and everything. I understand what they're doing here, and it's just very interesting. And it's technology that I think we need in many corporations and will benefit from.
Yeah, nice. Same Stan has asked us. He's asked us for a sanity check. So, inspired by Michael Burry's long horizon plays, such as in the health sector, he's building a UK dividend healthcare basket. So the companies are JSK, Hikma, Smith & Nephew, and Primary Health Properties. The average yield of all these is around 5.5 to 6%. He believes it's a solid defensive core. They all look undervalued in his opinion. So what are your thoughts on that?
Yeah, my issue is, first of all, is the English healthcare system. I never really hear anything good about it, but okay. I don't like GSK as a company, so that's already for me a no-no there. Hikma, I looked into it, it's producing generics. Generally, I like companies that are producing generics, so that could be something. I saw the dividend history on their chart on the investor relations was for 5 years ago, so I don't know what they did before that, whether it got the dividend. Smith & Nephew, I'm not really a fan of that. I looked into it in the past. I know it is a long dividend growth track record, but their products, they don't say anything to me. And then Primary Health Properties, I don't know that one. But in general, he says it's yielding 5 to 6%, right? I am biased towards British companies in the healthcare industry. So I understand probably why you would like to look into the British healthcare industry because of the 0% dividend tax that is being withheld there. Still, you need to pay the dividend tax probably in your own country. And I don't know if he's from the UK or not there, but I think there are some other interesting companies if you want to be in healthcare. And I would probably still look a little bit more at the US ones or look at the European big pharma. For instance, Sanofi, could be an interesting one to study with what they have in the pipeline and the cash flow it's spitting out. So Novartis seems to be doing a bit better lately, but then you have the 35% dividend tax from Switzerland that you will want to reclaim. No, it doesn't speak to me if you ask me personally.
But as a concept, if you're to ignore the UK kind of healthcare.
So what I like, it has properties in here. So the real estate, it has the generics, it has the innovative medicines, and it has the equipment, the tools. So it is really, really well diversified and very complementary to each other. That is definitely a really good setup.
Yeah. I think ignoring the individual companies, I think the concept,
the concept is really good. I think.
Good.
Yeah.
J. Rig Wealth Management has asked us our thoughts on the data center boom. They are picking up companies like MPLX, that's some utility fund, There also some consolidated water, which will help to kind of cool pieces that are used in data centers, and they give nice dividends across the board. So what are your thoughts on that?
Well, I generally like to invest in the pick and shovels of a new boom. Yeah, those are typically the ones that really earn the money, like ASML as well. Yeah. So yeah, I think it's generally a good idea. I'm just not equipped enough with understanding which companies will be the best for that. I think we did a podcast the other day on the AI picks as well. So, and I think you really brought up some good companies there. And yeah, what's interesting is that naturally I have quite some companies that benefit from this. For instance, Microsoft with Azure. Yeah. So it's funny to see that, right? How AI was popping up in my holdings and actually contributing to the earnings growth there. Yeah.
Yes, it's always quite interesting. I don't know MPLX all too well, but I think having the utilities fund, I've spoke about utilities quite a bit, especially the American ones. I think it's quite a smart play. I also like the idea of buying a company that will, cooling the waters. It's things you wouldn't think about unless you're technically involved in that area, but they'll definitely have some tailwinds there. So yeah, I think it's a great strategy. I think energy will increase anyway. We're using so much stuff. I think AI will propel that. I generally do. I just don't know if it's going to happen at the pace that analysts are predicting, because we got to do this safely and we got to do this without disrupting the current stability of electricity supply. So that's quite difficult to manage. So there's a lot of infrastructure might need it to be upgraded and to be put in place for that to happen. Yeah. But I think long term, I think it's I'm bullish on that sector. So I think it's a great fit.
But I would look for those picks and shovels where the cash flow will not be a one-off. Yeah, not for instance because you're selling cables. I think water cooling is more stable because that will be a one bump, but then it will be fully in the maintenance, in the OPEX of the company as well. Yeah. You don't want it only in the CAPEX, but you also want it to turn into OPEX.
But what I do like, on that point is what I like is these companies will grow whether AI boom will happen or not. It's just it'll grow faster with the AI boom.
It will grow faster for now, and that will give you more potential for dividend income.
Exactly. Martin has asked, have you ever looked at owning Louis Vuitton through Christian Dior?
Yes, I have looked at it, but I understand why he's saying that, because Dior gives a little bit more dividend per share. But somehow I prefer to own stocks directly. It's the same as owning, is it Atlas Copco via Investor AB? Yeah, it's something similar here where you can also just own Investor AB and you have a large stake in Atlas Copco. So I get the point. Usually I go for the company directly. Whether that's the smartest or not, I actually can't tell you. Probably not at times.
Yeah. So sometimes it's nice if you want to own them, if you want Christian Dior, it's a nice benefit having Louis Vuitton there. But I wouldn't just buy Christian Dior just to have a little bit of Louis Vuitton. So I'm like you, I prefer to own the company in general.
Okay, Martin is a smart cookie, so I think he has this better figured out than we did.
Yeah, 100%. Okay, and then the last question then we got from OOO, and I think he's asking us about the 2026 bet on shipping.
That's one for you because I'm not into shipping at all.
Yeah. Look, I touched on it briefly earlier on. They are expected to be soft to the start of next year. The impact of tariffs is still lingering, even though we don't hear it as much in some of the investor calls. It's still there. It's still lingering in the background with shipping. So look, it is risky. It's peaks and troughs. You got to buy it at the right time. But yeah, I can see at the moment it's quite soft. There's probably some good valuations there, so I can understand the interest in it. There's a guy on Twitter I follow, and I can't remember his name, Jay Moistmere or something. Very, very good. Has these quarterly calls on Seeking Alpha, which are free. Always very insightful, and I recommend checking him out. And don't listen to me, listen to him, I would say.
Good.
Nice. That is the end of the show. So again, thanks to everyone for listening. Apologies for my voice. I did get through this.
Get
Also,
healthy soon, Derek. And I very much appreciate that you show up for the community. You could have easily said, I'll pass on today.
no, we have a commitment. See you all next week.